Right now, somewhere in America, a truck owner is doing math they wish they had done before they signed. The truck is sitting in the driveway, the payment is sitting in the bank account, and the number on the loan statement is higher than the number any dealer is offering to buy it back. That gap, the distance between what you owe and what the truck is actually worth, has a name. It is called negative equity, and for a growing number of truck buyers in 2025 and 2026, that gap is not a small one. Here is the situation nobody in the showroom explains clearly. A $65,000 truck financed over 84 months with a small down payment does not protect you when the market moves. When resale values drop faster than your loan balance, when dealer incentives signal that demand is weaker than expected, when insurance rates climb, when repairs cost more than anyone budgeted, you are not just an owner anymore. You are financially boxed in. The truck has your money, your credit, and your options, and it is not giving them back easily. By the time most owners realize it, selling the truck does not solve the problem anymore. This is not a video about bad trucks. Some of the vehicles on this list are genuinely impressive pieces of engineering. The problem is not always the machine. The problem is what can happen when a high purchase price meets a long loan, a shrinking resale market, expensive ownership costs, and a buyer pool that turns out to be smaller than the marketing department promised. High price, long loan, fast depreciation, weak demand, expensive ownership. Those 5 things together do not create a financial problem. They create a trap. 6 trucks, each one carrying a specific financial risk that buyers need to understand before they sit down at the finance desk. The math on these vehicles can turn ugly fast. And by the time we get to number 1, you are going to understand exactly why the loan trap is not a future threat. It is already here. Number 6, Jeep Gladiator. Let me paint you a picture. You walk into a Jeep dealership a couple of years ago, and there it is. The Gladiator, an open air truck, Jeep DNA with an actual bed. Nothing else on the market looks like it or feels like it. The marketing is electric, the community around it is passionate, and the dealer, sensing all of that enthusiasm, is in no hurry to negotiate. A lot of Gladiator buyers paid a premium for that feeling, over sticker in some cases, and for a while the used market held up enough that it did not matter much. But markets move, and the Gladiator's market has been moving in a direction that owners need to pay attention to. Dealer incentives on the Gladiator have grown in many markets. That is not just a fact about savings for new buyers, it is a signal about demand. When manufacturers push dealers to move units with cash on the hood, it means that organic demand is not absorbing supply the way it once did. For someone who owns a Gladiator they bought at a premium, more incentives on new models creates direct downward pressure on what their used truck is worth. Here is the specific financial risk. The Gladiator serves a very specific buyer. It is not a mainstream truck. It is not the first choice for every contractor needing payload. It is not the first choice for every family needing towing. And even in the off-road world, some buyers may choose a Wrangler, a Tacoma, a Bronco, or a purpose-built trail rig instead. The Gladiator is for a particular kind of buyer who wants the Jeep experience with truck utility, and while that buyer absolutely exists, the pool is not enormous. Narrow buyer pools create resale risk. When you need to sell, the universe of people who specifically want a Gladiator at your price, in your trim, in your color, is limited. And limited buyer pools can push prices down. For an owner who financed at or above sticker with a long loan, that math can create a negative equity position that is genuinely difficult to escape without writing a check at the trade-in desk. If you own a Gladiator right now, I want to know one thing. Did you buy it at sticker, below, or above? And how does the current dealer pricing make you feel about your decision? That answer says a lot about where the real market pressure is right now. And if dealer incentive pressure sounds uncomfortable, wait until you see what happens when the premium price of a specialized truck meets the cost of specialized repairs. Number 5, Chevrolet Colorado ZR2. The Colorado ZR2 is a fascinating financial case study because on the surface, it is a genuinely good truck. It is well engineered. The off-road capability is real. The build quality is serious. Chevrolet has put genuine development into the ZR2 platform, and the result is a mid-sized truck that can do things most mid-sized trucks cannot. And then you see the price. And that is where things get complicated. A Colorado ZR2 can climb deep into the 50s with options. At that price point, you are close to the territory of some full-size pickups, a truck with more payload, more towing, more cap space, and in many cases, a larger, more established buyer pool for resale. The buyer who chooses the Colorado ZDAR 2 over a larger option at a similar price is making a very specific choice. And that specificity is exactly where the financial risk lives. The ZDAR 2 is built for off-road use. Specialized suspension components, specialized tires, specialized hardware. When those components need service, the cost reflects the specialization. This is not the kind of truck where every repair feels like a basic fleet truck bill. The ownership cost ceiling on a ZDAR 2 can be significantly higher than a simpler truck on a bad service day, and that is before you factor in tire replacement costs for aggressive off-road rubber. Off-road tires on a ZDAR 2 are not cheap, and if you are not actually running that truck off-road regularly, those tires are wearing on pavement at full price. The resale risk is the combination of price and audience. The buyer who wants a ZDAR 2 specifically is looking for off-road performance in a mid-size package. That is a meaningful but limited group. When you are ready to sell, the buyer pool that crosses both filters, mid-size preference, and genuine off-road intent at ZDAR 2 pricing is narrower than the market for a standard full-size truck. That narrowness can show up painfully at trade-in time. Here is the honest question every ZDAR 2 buyer should sit with before signing. How many miles a year are you actually using the capability you paid for? Because if the answer is a weekend here and there, you are paying a premium price for capability you are not extracting. That is a perfectly valid personal choice. It is just an expensive one. But compared to what is sitting at number 4, the ZDAR 2 is almost a conservative buy. Number 4, Rivian R1T. The Rivian R1T arrived with enormous excitement and not without reason. It was genuinely new, the design was original, the performance numbers were impressive, the storage solutions were creative. For a first-generation product from an independent automaker in an industry that almost never produces successful new entrants, the R1T was a real achievement. But here is the thing about buying a first-generation product from a younger automaker. You are not just buying a truck, you are making a bet, and that bet carries financial risks that a buyer from an established legacy brand simply does not face in the same way. The service network is the first practical issue. Rivian has been building out its service footprint, but coverage is not yet comparable to an established brand, and depending on where you live, a serious service issue could mean significant time without your truck, significant travel to reach a service location, or both. For a vehicle you are making a substantial monthly payment on, downtime is a real cost that does not appear in the window sticker. Battery replacement is the second issue. The R1T uses a large battery pack to deliver its range. Battery technology is improving, but long-term degradation is a real factor in EV ownership, and the cost of battery replacement on a large format EV truck is not a small number. For buyers financing an R1T over 6 or 7 years, the question of what the truck is worth at the end of that loan, after years of battery aging and in a market that may have significantly cheaper EV alternatives by then, is not a comfortable one to sit with. Launch pricing is the third issue. Rivian adjusted its pricing over time in both directions, creating a situation where some early buyers paid significantly more than later buyers for effectively the same vehicle. If you were an early adopter at peak pricing, the resale math may be working against you, particularly as newer versions of the R1T compete with your used truck in the secondary market. Here's a real question I want to put to anyone watching this. If a friend came to you today and said they were about to finance a Rivian R1T, what would you tell them? What has your experience or what you have read about shaped your thinking? That is the kind of owner perspective that changes the whole conversation. And if startup uncertainty keeps you up at night, the next truck on this list took that feeling and wrapped it in stainless steel. Number 3, Tesla Cybertruck. Let's talk about the Cybertruck because this one requires a specific kind of honesty. When the Cybertruck was first announced, the reaction was extraordinary. Reservations flooded in. The design was polarizing in the most attention-generating way possible. It looked like nothing else on the road. And for a certain kind of buyer, that was the entire appeal. But the truck market is built on a specific kind of buyer. Not only the early adopter enthusiast, the actual majority of truck buyers are people who need capability, reliability, and long-term value. Contractors, tradespeople, farmers, fleet operators, families who use their trucks as tools. And for that buyer, the Cybertruck raises questions that are genuinely difficult to ignore. The stainless steel body is one of them. It is distinctive, it is strong in certain ways, but it is also the reason repair costs after even minor accidents have emerged as a significant concern. Traditional body repair processes do not apply in the usual way. Specialized facilities may be required. Insurance can become another meaningful cost depending on location, coverage, and repair complexity. For a truck owner already carrying a high monthly payment, that additional drain compounds month after month, year after year, in ways the original purchase decision did not fully account for. The design is the second question. The Cybertruck's angular aesthetic is a feature for buyers who specifically want it for resale purposes. It can also become a limitation. When you decide to sell, you are looking for a buyer who specifically wants a Cybertruck, not just any capable truck. Unusual designs limit the size of the buyer pool, and smaller buyer pools create pricing pressure at exactly the moment you least want it. The early hype cycle is the third issue. The Cybertruck attracted buyers at or near peak enthusiasm pricing. Some paid significant premiums to take early delivery. As production scaled and the initial wave of demand was absorbed, the secondary market began reflecting a more sober view of value. Buyers who paid a premium at peak may find the resale market does not share their original enthusiasm. If you own a Cybertruck, there is one number I think most people outside the ownership experience genuinely do not know. What is your insurance running per month? That number would tell us more about real ownership costs than any spec sheet ever could. What comes next is a truck that makes the Cybertruck look financially straightforward by comparison. Number 2, GMC Hummer EV pickup. I want to say something about the Hummer EV that a lot of people are reluctant to say out loud. This is a vehicle that can genuinely do remarkable things. The acceleration is shocking for its size. The technology inside it is legitimately impressive. The presence on the road is undeniable, and it can cost around or above $100,000. It weighs around 9,000 pounds, and it delivers real-world range that requires careful management on anything resembling a longer trip. Let that combination sit for a second. The financial risk on a Hummer EV pickup is not subtle. The starting transaction can be close to 6 figures or beyond. For many buyers, that means a very large loan balance from day one. Large loans on depreciating assets require the asset to hold its value reasonably well for the math to stay manageable. And that is where the specific challenge begins. The Hummer EV's buyer pool is narrow in a very particular way. This is a vehicle for someone who wants maximum presence, maximum status, and the novelty of extreme electric performance in a truck-shaped package. That buyer absolutely exists. But the contractor who needs to carry tools does not need 9,000 pounds of truck. The family with a budget does not need a vehicle with that kind of price and range management concern. The fleet manager is not usually purchasing Hummer EVs for the work pool. When you are ready to sell, the buyer must be a very specific personality type with a very specific budget, and that combination is not common. The battery is the long-term concern that nobody buying new wants to think about. The Hummer EV uses one of the largest battery packs ever installed in a consumer vehicle. That battery is impressive. It is also expensive to replace if degradation becomes meaningful over the ownership period. The potential cost of battery replacement on a pack of that size is not a number most owners want to research before they sign, but it is a number that matters enormously when calculating total cost of ownership on a large loan. Have you run the full ownership math on a Hummer EV? Insurance, charging costs for a battery, that large realistic resale in 5 years, potential battery servicing long-term. If you have done that math honestly, what you found is exactly what the window sticker never shows you. And if a 6-figure loan on a vehicle with a narrow buyer pool sounds uncomfortable, what comes at number 1 is the version of this story where the trap is not theoretical. It is done, it is closed, and the owners inside it have nowhere to go. Number 1, Lordstown Endurance. Everything on this list involves financial risk that may or may not materialize depending on market conditions, loan terms, and timing. But number 1 exists in a different category entirely, because with every other truck on this list, the risk is still a question. With the Lordstown Endurance, for the commercial buyers who took delivery, the worst case scenario has already largely materialized. Lordstown Motors launched with an electric truck built specifically for fleet use targeting commercial operators who wanted to electrify their work vehicles. The Endurance used an innovative hub motor design that generated genuine industry attention. The company attracted substantial investment. It went public. It generated real excitement among people who believed in its mission and its technology. Production was extremely limited. A small number of vehicles were delivered, primarily to fleet customers rather than individual consumers. But those deliveries happened. Those transactions were financed. Those vehicles were put to work. And then in 2023, Lordstown Motors filed for bankruptcy. Let that sit for a moment. The company that built your truck, that promised service infrastructure, parts availability, software support, warranty backing, and a long-term ownership relationship went bankrupt. The support structure that every vehicle purchase implicitly depends on ceased to exist in any meaningful operational form. For Endurance owners, this is not a hypothetical. The manufacturer support that should stand behind any vehicle is effectively gone. Parts availability is a real and ongoing concern. Service expertise for the specific Endurance platform is not expanding. Software updates, which modern electric vehicles depend on in ways traditional trucks do not, are not coming from a healthy resource company with an engineering team focused on your vehicle. The resale market for a Lordstown Endurance is, to use the kindest possible word, extremely challenging. Who is the buyer? Who will finance the purchase of a vehicle from a bankrupt manufacturer with uncertain parts availability, no active warranty backing, and limited service expertise available in the market? The honest answer is that the willing buyer pool is very small, and the price that pool is willing to pay reflects that reality clearly. This is the most complete version of the loan trap that this video describes. High price paid, value moving in one direction. Uncertain ownership, future, no corporate structure to appeal to, no goodwill program, no executive to call, just an owner holding an asset the market does not know what to do with, and a loan balance that does not care about any of that. Is there anyone watching this who has direct knowledge of the Lordstown Endurance ownership experience, from fleet operators, from people who dealt with the service situation after the bankruptcy, from anyone who was close to this story? I would genuinely like to understand what the real world picture looks like. That story deserves to be told honestly. Here's the thing that connects all 6 of these trucks. The problem is rarely the vehicle in isolation. The problem is what happens when a specific vehicle meets the wrong financing structure at the wrong moment in the market. Think about the formula. You start with a high purchase price. In the current truck market, that can easily mean 60, 70, 80, or more than $100,000. Then you add a long loan, 72 months, 84 months, terms that have become normalized in an industry that decided stretching payments was easier than lowering prices. Then you add a small down payment, because most buyers do not have $20,000 or $30,000 ready to put down. And then you add a vehicle whose specific buyer pool is narrow, whose resale value is uncertain, or whose manufacturer support is in question. At some point in that loan, the gap between what you owe and what the truck is worth can become very large very fast. Not because you did anything wrong, not because you made a careless decision, but because the math on these purchases does not leave much room for the market to move against you. And markets have a habit of moving against you at exactly the wrong time. The loan trap does not announce itself at signing. It announces itself when you try to sell, when you call a dealer for a trade-in quote and the number is lower than your payoff. When life changes and you need to get out of the payment and you discover that getting out means writing a check because the truck is worth thousands less than the balance. When you call a lender about refinancing and the conversation does not go the way you hoped. The smartest thing any truck buyer can do right now before they sit down at the finance desk is to run the full ownership math on what the vehicle might realistically be worth at the midpoint of the loan, not what the window sticker implies, not what the optimistic projection suggests, what it might actually be worth in 3 years in a market that may have added new competition, may have delivered a better version of the same vehicle, and may simply have more supply than the demand can absorb. If that math makes you uncomfortable, it should. A bigger down payment, a shorter loan term, and a realistic, honest look at where resale values are trending on that specific vehicle right now, those are not signs of pessimism. They are signs of protecting yourself, because the loan trap is not going to warn you when you are about to walk into it. It only shows you the walls once you are already standing inside.